Welcome to ValueVest Daily. Today, we are diving deep into the hunt for that sweet, consistent 10% plus monthly yield. And folks, it's shaping up to be a real showdown between a disruptive new player from the crypto world and, well, the established giants of Wall Street. This is the battle for your income portfolio, and trust me, the winner might not be who you think.
So, let me ask you, are you trying to get your money working harder for you in 2025? I mean, really generating serious passive income? Just imagine a 10% or even higher return hitting your account month after month. That kind of cash flow is a game changer. So stick around, because this breakdown could seriously change the way you think about building your income stream. Let's get right into it.
All right, in this corner, we've got the digital newcomer, STRC. This is a unique security from Strategy Inc., and it's backed by their absolutely massive treasury of Bitcoin. And in the other corner, the Wall Street powerhouses, the traditional ETFs you probably know, JEPI, JEPQ, QYLD, and SDIV. We are going to break down their yields, their risks, their real returns, and a huge factor most people forget, taxes.
Okay, first things first. How do these things actually make the money that they send you every month? The strategies are totally different, and understanding what's going on under the hood is absolutely critical. You got to know what you're really buying.
So, most of the ETFs we're talking about today use something called a covered call strategy. Now, in simple terms, they own a bunch of stocks like the S&P 500 or the NASDAQ 100, and then they sell options against them. You can almost think of it like they're renting out the upside potential of their stocks. For doing that, they collect a fee, a premium, and that premium is what they pass along to you as that high monthly payout. It's a great way to generate income, but there is a catch. You're basically putting a ceiling on your potential gains. If the market just rips higher, you're not going to capture all of it. We'll definitely come back to that.
Now, STRC, this is a completely different beast. It's not an ETF at all. It's more like a preferred stock, and people often call it a digital bond. Its value and its ability to pay you is directly tied to Strategy Inc., which, by the way, holds a mind-boggling 650,000 Bitcoin. The dividend it pays out comes from the company's cash flows. So what you're really doing is making a direct bet on the company's health and the long-term price of Bitcoin. That's a very different game.
Okay, let's talk about the silent killer of returns, fees. I mean, look at this. Every single dollar you pay in fees is a dollar that's not in your pocket. Right off the bat, STRC, since it's a direct security, has a 0% expense ratio. That is a huge advantage. Now, the ETFs, JP Morgan's JEPI and JEPQ are pretty lean at 0.35%, but check out QYLD and SDIV. They're quite a bit higher. It might not seem like a lot, but trust me, that little bit of friction creates a drag on your returns year after year. It really adds up. And that brings us to the absolute heart of our analysis today. Look, everyone gets excited about a big, juicy yield number, right? But is that number the whole story? No way. Not even close. We have to look at what's happening to your original investment over time, because this is where a lot of investors get into big trouble.
And here they are, the numbers that get everyone's attention. I mean, just look at that. QYLD is the undisputed king of the hill, clocking in around 12.5%. STRC and JEPQ are right there in that sweet spot, both over 10%. These are the flashy headline numbers that make these tools so popular. But as we know, a high yield can sometimes be hiding a pretty nasty secret.
So this is the critical question we have to ask. What about the total return? We're not just looking at the cash payments here, we're talking about the whole shebang. What happened to the share price? Did your initial investment grow, or did it actually shrink? Because that, my friends, makes all the difference in the world.
And boom! This slide just lays it all bare. On the one hand, look at SDIV. Not only did you get a nice dividend, but its price actually grew over 13% a year. That's just incredible. But now, look down at the bottom. QYLD, our yield king from the last slide, its price actually went down by 5% a year. This is the classic yield trap. You're getting these huge monthly checks, but it's coming at the cost of your original investment. This is exactly why you cannot judge these things by yield alone.
All right, now for what might be the most important and honestly the most overlooked part of this entire comparison. We need to talk about taxes, because what you see on the screen isn't always what you get to keep after Uncle Sam takes his cut.
Right, so the way your payouts are taxed can have a massive, massive impact on your final return.
If you're in a higher tax bracket, a 10% yield can easily shrink down to just 6 or 7% if it's taxed as ordinary income. The key here is that not all dividends are created equal in the eyes of the taxman. Understanding this little detail can save you thousands.
Okay, now this slide tells a really fascinating story. Just focus on that top line. STRC's payouts are often treated as a return of capital. What that means is you don't pay income tax on it the year you get it. Instead, it just lowers your cost basis so you defer the tax until you eventually sell. This is huge. It gives it what's called a tax equivalent yield of around 16% for this tax bracket. Now look at the others. They get hammered by ordinary income tax. QYLD does a little better, but nothing comes close to the tax power of STRC. For anyone investing in a taxable account, this is an absolute game changer.
So we've looked at how they work, the returns, the taxes, but hey, there is no free lunch in the world of investing. So now we've got to talk about the risks and figure out which one of these tools is actually the right fit for you.
Yeah, every single one of these has trade-offs. For STRC, the risks are pretty significant. It's basically junk-rated debt, the dividends aren't guaranteed, and everything is tied to the crazy volatile world of Bitcoin. A crypto winter could mean payments stop. For the covered call ETFs, you're capping your upside. If the Nasdaq has a monster year, you'll miss out. JEPI is a bit safer, but you'll still miss some big gains. And SDIV, being global, has geopolitical risks. You have to know what you're giving up to get that yield.
So, how do you pick one? It all comes down to who you are as an investor. If you are a die-hard Bitcoin bull and you want that leveraged exposure with insane tax benefits, well, STRC is in a class of its own. If you just want the biggest possible monthly check and you're okay with your principal maybe shrinking a bit, QYLD is your tool. For more stable, reliable income from traditional markets, JEPI and JEPQ are fantastic. And if you want to diversify away from US tech, SDIV is the clear choice. See, there's no single right answer, just the right answer for you.
And that leads us to the final question, the one we started this whole thing with. After breaking it all down, which tool is actually the best for generating that 10% plus monthly income? And the answer is, there isn't one. The best tool depends entirely on you. It depends on your belief in Bitcoin, how much risk you're willing to take, and as we saw, it really depends on your tax situation. The whole point of this explainer wasn't to give you the answer, but to give you the framework so you can find your answer.
Now, of course, it is essential that we say this is not financial advice. All the data we presented is based on our research as of December 2025, and as always, past performance is no guarantee of future results. Please do your own homework and think about talking to a qualified financial professional before making any investment decisions.
If you found this breakdown valuable and it helped you connect some dots, do us a huge favor. Please take a second to subscribe to ValueVest Daily, like this explainer, and share it with someone you know who's also on the hunt for high-yield income. We put these out to help you invest smarter.
Hey, and one more thing. If there's a specific stock or ETF, any ticker symbol that you want us to give the same deep dive treatment to, let us know. Drop it in the comments below. We'd love to check it out for a future explainer. Thanks for watching.